there, and welcome to another Monday and another 5 with Fitz. I hope you had a fabulous weekend wherever in the world you are watching this. My wife and I snuck away for some wonderful motorcycling and a quick getaway in the Cascades, and boy, I wish I could share that with you because it was spectacular. Anyway, let's get down to it. So, the markets were in a nasty mood this morning, or so went the story. Now, not really, but we're going to play along, right? I mean, the facts present a very different picture. Roughly 98% of the S&P 500 companies have reported, and of that, 64% have reported positive revenue surprises, and 78% have reported positive EPS surprises, which goes to show you that once again, A, the street has gotten it wrong with the constant fear-mongering, and B, that companies are making serious headwinds on operational efficiency and sales, exactly as I suggested they would. Now, while we're at it, and before I forget, the blended EPS growth rate is also impressive, 13.3%, the second consecutive quarter in a row of double-digit growth, if memory serves. Now, it is not a surprise to me, and I trust not to you either, that the markets are now within a few percent of February highs as I record this, and that there's still a fuel in the tank, a lot of fuel in the tank. So why does the rally feel so fragile to so many people? That's a good question. And it comes down to one thing. There's still a lot of tariff uncertainty. But here's what you want to think about. The thing, really. Investors who know how to play the game and who understand the bigger picture that we talk about so frequently also know that AI and big data, among a few other themes that we discuss regularly around here, are going to drive our world for decades, which is why I personally have no problem investing into any weaknesses if it surfaces. Now, here's my playbook. Number one, the one earnings report that matters all week, in my humble opinion. The ever-brilliant Stuart Varney asked me for my take on CrowdStrike earlier this morning ahead of the opening bell, which reports after the closing bell today. Long story short, it is still a no-brainer, at least in my mind anyway, as the old expression goes. He also asked me about Palantir, which continues to track higher. Now, I hope you're on board with both companies. If not, think about why not. And I say that because a new generation of millionaires is being printed, and predictably, right now, many investors are still missing the run again, despite having sworn up, down, and sideways that they wouldn't. Anyway, watch the video elsewhere on my channel for my complete take. I hope you enjoy it. And by the way, if you don't think this is important, I urge you to reconsider that premise. CrowdStrike has returned 153.02% since I brought it to the OBA's family's attention versus 25.66% from the S&P 500 over the same time frame. Now, if you're doing the math in your head, like I'm prone to do, that's nearly a 6-to-1 performance advantage. And history, by the way, suggests that there are 10 to 15 CrowdStrikes out there right now in various stages of maturity, several of which are OBA faves, which is, of course, why I suggest you own them. At least for the OBA family, anyway. What's more, the profit potential is accelerating. Now, to be fair, I could have been entirely wrong. This is a super tough business, so I'm not telling you this to brag. That's not my style. The point I want to make is that innovation has never failed to produce huge profits for those who get on board early and for those who stay along for the ride, ever. So playing to win is very different than playing not to lose. Think about it. Number two, my new year-end target for the S&P 500. Now, if you've been reading along for any length of time, you know that I don't mince words. I'm starting to wrap my mind around the S&P 500 finishing the year at 6,500, perhaps even 6,600. AI is still accelerating revenue and earnings too. At the same time, inflation is falling like a rock in many categories. Now, investors who have sat this one out since April because they thought they were being smart are very likely realizing they've made one hell of a mistake, and a very expensive one at that. FOMO, which fear of missing out, could propel things higher faster than history suggests it will. It won't be a straight line, of course, but nothing ever is. The thing is that I want you to focus on, the path is clear for those who know where to look. Now, that's really the rub, isn't it? Many investors are still, unbelievably, so busy playing not to lose that they wouldn't know how to play to win if it bit them in the butt. Now, that's a shame because investing in opportunity is always more profitable than cowering in fear. I'm just saying. And by the way, there's a chart really, that I want you to look at in today's written version of the 5 with Fitz, the 6th wave, We're on the cusp of the sixth wave, and it is very important from an investing perspective that you understand that and have some provision in your portfolio made for investing in that future. Number three, the tariff tangle that equals tactical opportunity. Now, U.S. President Donald Trump's surprise move to double U.S. steel tariffs to 50% has the market scrambling as I record this. U.S. steel makers, including Nucor and Steel Dynamics, have popped on the news. But, and you knew this was coming, rising inputs are also going to mean downstream pain for automobiles, appliances, and construction, anything that uses steel. Meanwhile, at the same time, European prices drop as supply floods their markets. Now, that's typically bad news for companies like BMW and Orsted, both of which could feel the squeeze. So what to do as an investor? Well, the proverbial cat is out of the bag, which means that everybody knows the story. So it's time to invoke what I call Keith's rule of the back page, meaning that it's time to look at the stories on the back page that haven't hit yet. Like, for example, what happens when tariffs go away, or at least get squared away? In other words, starting to bet against U.S. steel companies like Nucor, Steel, others, related names that have popped today. Now, the easiest way to do that is to short, avoid, or to simply buy put options while they're cheap. That's a bet that the stock will go down. And meanwhile, if you are following along with U.S. steel makers and have bought into the rally, A, well done, and B, make sure you have some very tight trailing stops in place for the simple reason that when this trade fails, it's going to fail fast. Now, Keith's investing tip in this area is something you want to think about. Policy risk moves fast, but profits almost inevitably move faster, but only if you're ready. Let's talk about number 4. Paradromics just pulled a Neuralink. Now, Paradromics, a company that I hadn't heard of until very recently, just pulled a Neuralink, the first human brain implant done and dusted at the University of Michigan, no less. Now, it was a smooth procedure, zero drama, which is exactly what you want when you're literally wiring someone's brain. Now, while the headlines scream medicine, make no mistake, this is the starting gun for something bigger, something far more critical. The commercialization of cognition. And that's a mouthful. Try saying that 5 times real fast. It's a race to commercialize thought. Now, Paradromics tech reads individual neuron signals, which is like neural eavesdropping with a front row seat at the show. Now, it's still private, yes, but smart money's already flowing into several key areas of medical tech infrastructure. Chip makers, signal processors, surgical robots, and AI layers. And again, I know I sound like a broken record, but I hope you've got something like this covered somewhere in your portfolio, because there's a very good chance it's going to cost you significantly if you don't. It is only a matter of time, folks, before truly customizable medicine arrives, and implants have a very significant role to play in that process. Now, the OBA family, of course, again, has been tracking this stuff for quite some time, and if that's helpful, honestly, I'd love the opportunity to welcome you on board by earning your trust, your goodwill, and your business. If you've got this covered, again, excellent. No offense taken if you don't come on board. I'm happy for you. But my POV is what you want to understand. The fortune isn't in the device. It's in the ecosystem that devices like this one need to exist. And while we're at it, a reminder that missing opportunity is always more expensive than trying to avoid risk you can't control. And finally, I want to talk about something that comes up. Point number 5 today. Should you be like Buffett or even try? Now, I get this question a lot, and it's logical given how much he's in the news. The Oracle of Omaha reportedly now owns 5% of the entire short-term U.S. Treasury market. And of course, many retail investors are racing to follow suit. Okay, fine. ETFs like SGov and BIL, which focus on ultra-short T-bills, have pulled in billions this year as investors are trying to dodge volatility and prepare for market uncertainty. Should you be doing the same? I mean, that's really the implication of a headline like this, right? That's why the news agencies and the clickbait artists are hoping to draw you in, because everybody wants to be like Buffett, right? Should you? Well, that depends. Now, not for nothing, the OBA family has beat Buffett to the punch with SGov, which I recommended in October of 23. Get that? October of 23 as a great place to stash cash, earn a decent chunk of change, and hedge against the Fed's follies, which have been ongoing. Now, it's still a great choice, by the way, which brings me to what I really want to talk about with you today. Many folks try to imitate Buffett, but that is dangerous for various reasons. First, you're not Buffett, and neither am I. He's got tens of billions of dollars in float, can move entire industries with a quote, and get sweetheart deals that nobody else often does, typically behind closed doors, using tactics that you cannot possibly hope to emulate. Second, timing. The Oracle plays a long game, decades, not days, and has stated publicly many times that he's content to wait for opportunities no matter how long they take. Now, most retail investors don't have that kind of patience or cash cushion, so they can't do it. And number three, his risk tolerance and access to information are not yours. Investing is an individualized process with individualized goals, risk tolerances, objectives, and circumstances. My POV is super simple. Investing is not a competition, so you shouldn't view it that way. Borrowing somebody else's playbook works only if you've also got their stadium, their team, and their scoreboard. At the risk of being very self-serving, this is exactly why I built One Bar Ahead the way I did. Our premium research is personalizable, not prescriptive. And it's a tool you can use to shape your goals, your risk tolerance, and your time horizon. Now, investors around the world tell me very frequently they love how OBA meets them where they're not where Wall Street thinks they should be. So here's the investing tip at the end of the day. Cookie cutter strategies are for cookie cutter results. And if that's what you want, and you're okay with that, fine. There's nothing wrong with it. My point is, history suggests you deserve better and probably can do better. Today's bottom line, success by its very definition includes failure, which means that you've got to learn to love the downside just as much as you love the highs. As always, let's make it a great week, great start to the day, and do everything to the best we can. You got this, I promise. I will see you again tomorrow. Thanks for watching.